Good morning, everyone. Thank you very much for joining us. As we'd advertised in the invitation, we are going to focus today on sharing with you tax saving ideas based around business, because business is, for the vast majority of people, the way in which they accumulate substantial wealth. So our first speaker, Martin Nicol from Accountants Plus, and our second speaker is Matthew Den from AP Wealth. Each speaker will present for about 20 minutes, and at the end of the 20 minutes, we'll take any questions. Please use the Q&A function to deliver your questions. You'll see the Q&A bar at the top of your screen. So we'll start off with Martin, and he will then pick up questions, and we'll then transfer to Matthew, and Matthew will deal with questions at the end. So, Martin, it's over to you.
No problem. Thanks, David. As Dave said, my name is Martin Nicol. I'm the Technical Tax Manager at Accountants Plus. And the main focus this morning is looking at the tax that would then occur on a potential business sale, and what kind of things we can do to reduce that liability that would be due. David, if you want to get the slides.
Sorry, Martin, can you share from your side?
No, 1 sec. Okay, so the first area to have a wee look at is the different types of business sale that can happen. So there's two main ones. Firstly, we've got an asset sale. And an asset sale is where a business is sold, but it's the assets that it holds in the trade. So it's not really taking ownership of the company. It's then just really absorbing your business into your own, and into the purchasing business. And with that, what would happen is there would be kind of corporation tax payable, just as if you had sold an individual asset or a normal kind of sale. From there, what the kind of the issue you would then see is the proceeds that from that sale, they would be locked within the company that you've got, and then there's going to be additional tax coming out of there. So from that, you're looking at paying between 19 and 25% of the overall sale price, and then again, you're then looking at additional self-assessment kind of taxes, trying to extract that money out of the company. The other type of sale that would happen is a share sale. Now that's when someone would come along, buy the individual shares in the company and take complete ownership. And that's what I'm looking to focus on today, because these sales are the ones that benefit you as the seller, rather than it being the buyer. So that's where there's some tax gains to be made. Initially, what I wanted to look at is just how capital gains tax would work. So if you were to sell a business and done nothing about it at all, this would show what taxes would be payable. So firstly, the first £3,000 that of the sales price, they would be tax free. Everything else that you would have got, they would be taxed at either 18 or 24%, depending on what your income levels are. Now, that can obviously add up to quite a lot of money, and it all kind of depends on what other income you've made. So this is tax that's going on top of all your income tax you paid in your salary, any other rental income, interest, dividends, everything kind of gets brought in. So again, timing of things can come into it depending on how your income fluctuates year on year as well. If the sale had occurred previously, it would have been 10 and 20%, but again, it's the rates in the budget there in the end of October changed it, so it's now 18 and 24 on any gains on the way forward. The biggest relief that's available, which definitely helps when selling a business, is business asset disposal relief. This was previously known as entrepreneurs relief. It's been around for quite a while. They do kind of change the value of how much you're entitled to for the relief, and it's currently sitting at £1 million. So the first £1 million that you sell in a qualifying business, that would then, as it says, it reduces the tax payable, so everything's at 10%, and that doesn't take into account any other income you've got. The first £1 million of the gain is at 10% tax, which compared to the 18 or the 24 is definitely a big tax saving there. Unfortunately, with the budget in October, they have announced that the tax rates are increasing, and from April 25, it's 14% tax that be payable, and then again in April 26, 18% tax. So from there, again, timing does come into it. If there was a sale that was getting discussed at the moment, we would be looking to see, is it possible to do it before the end of the tax year, in the 5th of April, or definitely before the end of April 26, before it takes that step up again. The business asset disposal relief is a lifetime relief. So with the £1 million, if you've got more than one business, or you've sold a business before, it's possible that if you've claimed entrepreneurs relief or business asset disposal relief before, then you do need to kind of take that into account and make sure that the overall relief that you've received isn't any more than that £1 million. There is a few criteria that the company and the shareholders need to meet for business asset disposal relief to apply, and it's mainly for 2 years before the date that it's sold. The individual who's selling the shares, they need to have 5% of the overall control of the company. So that's the share capital, the voting rights, and the rights if the company was to liquidate or sell, make sure they've got entitlement to the profits. The individual also needs to be an employee or an office holder. So again, being a company director, a company secretary, or just an employee on the payroll, that would meet that criteria as well. And also the company needs to be a trading company. So by that, what I mean is it's not substantially holding any investments. The overall rule for that is you are allowed some investments within the company. So if there is a wee bit of excess cash sitting there, a build up of cash over some years that wasn't really getting used for the trade, or if there was an investment portfolio where some spare cash had been invested to get some interest through, as long as if someone was to come along and look at the company and say, no, it is a trading company, there's no big build up of anything, then it would still qualify for that. And it's definitely something that we can help and can have a look at for you. When looking at any sale of a business, the important thing to consider right at the start is who is going to buy the company. The reason for that is the avenues that would get taken, the different kind of reliefs that's available, or what we'd try and do to make the business optimised for a sale that can change depending on who we're actually targeting, who's the one that's going to come along and buy the company. So for a third party coming along, such as a competitor coming to buy you out or anything else like that, somebody who's looking to get into the sector, you're looking to make sure that the business is as systemised as can be, it's as profitable as can be, and it does look very attractive for someone coming along. Now, if that was going to a family member and we were looking at putting wealth to the next generation, from that side, it's not as important. They're still obviously want to make sure the company is as profitable as can be. However, there's different reliefs available that can come into that. And again, sale to employees and management buyout, the systemisation there can help. But again, the approach we would take to things would be a little bit different there. Right at the start, whenever we're thinking about, right, okay, there might be a sale coming along down the line, we need to kind of look at, leading on from who's it going to be sold to, how is the business going to look? We need to establish what is the business worth just now? If someone's to come along and buy it today, what kind of price could we expect from it? What ideally would I look for down the line? What kind of things do we need to do to bridge that gap? So from there, we're making sure we've got things in place like budgets and forecasts. We've got up-to-date bookkeeping there, which will then help feed into that. Having some key performance indicators to make sure that the goals that we're setting, to make sure that the sales targets are being hit, we're achieving them, and stepping back and making sure we're taking a regular review of exactly what's happening throughout the year, and making sure that we're not waiting until after the event, making sure we can fix things as we go, so we're always staying on track. I've mentioned systems there as well, making sure we've got a good bookkeeping system there. That can help reduce the amount of work that's involved in preparing budgets and forecasts and having that regular review as well. With that being up to date, there's systems there that we can definitely help implement so that it cuts down in the amount of time and still gets you the results that you're looking for. Looking at things we can do to reduce the tax liabilities that potentially are due on a sale, we would need to look at how everything in the company is set up at the moment. Who is the existing shareholders? Is there anyone else that we potentially want to include within the sale? One of the common ones are spouses and civil partners. That means that whenever that happens, the £3,000 annual exempt amount for capital gains, we can get 2 lots of that if we've got both spouses there involved. And the benefit, one of the good things with it is when you transfer shares from one spouse to another, there's no capital gains tax payable. It's done on a no gain, no loss basis. So nothing happens. The gain would basically just be split between both of them. The other option that's available is if we're gifting it to other family members, we have what's known as gift holdover relief. That also would result in no tax being payable at a time as long as no money changed hands. But what would happen is it would transfer again, similar to spouses, at base cost. So the tax bill would then move with the shares. So when the shares are sold down the line, rather than being the market value that they would have transferred over at, they're at that initial base cost, which commonly can just be the pound or £50 or whatever was set up as that share capital that was set up there. There's a little bit of paperwork needs to be involved with that, with joint elections, so we need both parties to be happy that that tax bill will be moving hands there. But we do see that as being one of the common options there. With that, with any transfers between spouses or if shares are being moved between family members, we do need to consider the business asset disposal relief. So again, we need to have that 2 years. So this needs to be done a little bit of time in advance of anything potentially happening, as well as are they involved in the business, because that could determine what rate of tax is ultimately going to be payable as well. The other one I've got is employee ownership trusts. Now, these would happen when the employees are looking to buy the business, or there's no buyer for the business, like a competitor's not really looking, but we've got a good team and it's potential that they could then own the business and run it from there. So this government initiative does provide some significant tax benefits. One of the big ones is whenever the shares are sold to an employee ownership trust, there is no capital gains tax for the seller. So that's a really big win from that point. As the seller, you can still retain some involvement within the company. As long as the employees have more than half of the shares, then that's fine. But again, you still can contain a little bit of involvement and be there on an advisory basis to ensure that the employees can pick up the business and run from it, run it on the way forward. The other benefit for the employees is they can have annual bonuses of up to £3,600, which is completely free of income tax. So that's saving them from the normal PAYE being either 19, 20, 21, 42. It's good from that point. But also because the company has made that payment, the company would still get that tax deduction off their corporation tax as well. So that's saving another 19 or 25%, depending on the company profits at that point. With an employee ownership trust, it's common that the employees won't have the money to buy the company out immediately. And what we normally see is it does mean that the seller would be paid out over a period of time from the profits over a couple of years, just to spread that across to give time for the company to generate the profits that they need. There is other options available. Again, it's difficult to advise on every scenario. These are generic things that can be done, but one of the things that would be worth doing is if anyone was looking or thinking down the line they are looking to sell, it's definitely one that we would look at and look at the exact specifics of how the company is and what the goals are, and build something up from there. David, that was me.
Right, Martin, thank you very much. So I was just checking, we don't have any questions at the moment. So Matthew, can we move on to you?
Turn that on. Martin, would it be all right, given you've got the slides open already, if you can be my slide mover, if that's all right?
No worries.
But look, thank you very much for your time. That was a great introduction there, Martin. So I think the seminar is incredibly timely in light of the budget there, less than sort of 3 weeks ago now, or 3 weeks almost to the day. So a lot of change out there at the moment. And I think, like with any change, it's important to understand what affects you and what doesn't. And Martin made a really good point at the end there that sometimes it's difficult to generalise and then bring it back to your own situation. So hopefully my presentation gives you a bit of an overall view of what the current landscape is and where there might be some opportunities depending on your specific circumstances. So if you could turn the page, Martin, please. So what we're going to do today, we're going to do just a bit of a case study as such. You know, this isn't meant to be, you know, illustrative of anyone's particular circumstances as such, but what we've tried to do is encompass what we see often as common background factors in people's situations, and how, you know, we as both tax and financial advisors, and it's really important to emphasise this, that Martin and his colleagues, myself and my colleagues, work in conjunction with one another to try and bring about the best outcome, both from a financial point of view, but also to what Martin was talking about there as well. There's other non-monetary factors at play there, particularly when it comes to making a move from working and owning and running a business to then enjoying the fruits of your labour as such. So looking at the following scenario here, we've got a limited company. It's owned 50-50 between husband and wife. So again, Martin touched on interspousal transfers. So it brings about net proceeds. So we'll park to one side what the entrepreneurs relief or business acquisition relief, whatever was. They've walked away with £1.8 million. They're 60 years of age. Their annual expenditure, net expenditure, is around £80,000 per annum. So what we want to run through here is 3 scenarios. First of all, they do nothing. The money simply sits in the bank account and they draw that money down progressively over time, and there's no planning put in place either before or really even subsequent to the business sale there as well. The second scenario is where the money's allocated into pensions where possible before a sale, but then also post that sale, that tax planning continues using ISAs as well. And at outset, the pensions are used. And it's really important to emphasise that point, that the pensions are used for the funding of that retirement. And to be clear here, we're talking about private pensions as opposed to state pensions, albeit state pensions are clearly something to bear in mind. And the third scenario is as per the second scenario, but instead of the pensions being used first, the ISAs are used first. And we think that having these 2 variations is quite timely in light of what happened a few weeks ago in the autumn statement there as such. So Martin, if you'd be good enough to turn the page. So in the lead up to the business sale, and this is really important, you know, it's that planning that goes in advance before the transaction actually takes place. So in the 5 years leading up, again, we're just using a very generic example here, each the husband and wife or civil partner, £100,000 each is the drawings that they take out of the business there as such. As to how that income's structured, again, that's another thing to think about. Is it dividends? Is it salary? What's the best thing for your situation? Again, that expenditure of £80,000 per annum, it continues until their respective 100 birthdays. We're assuming, because of their ages at the moment, that they'll get their state pensions at 67. So for some people, at the moment, they may get their state pensions at 66, 67 is the next jump up, and then there's 68 after that. We're assuming a main residence here, mortgage-free, £600,000. They've got £25,000 in the bank, earning 2.5% interest. We're doing this presentation 3-4 years ago, we probably wouldn't have an interest rate. We'll put something in there. Again, we've got the net proceeds from the business sale. And then what we've got, you know, they've done a bit of planning in the past. They've redirected monies from their business or elsewhere. They may have had pensions from previous employments before they started the business. So the husband in this instance has £100,000. We're just going to assume that there's a 3% return on that investment. And we're going to assume also that it's lifestyled. Might get into great detail about that today, but what a lot of pension companies do is they'll automatically de-risk, so sell shares and buy more bonds in the lead up to a specified age, sometimes called the normal retirement age. So the good thing about some pensions, they do that automatically for you. Again, something in your own circumstances you'd need to review depending on what you've got in place. For Mrs., she's only got £75,000, everything exactly the same, and her money's actually held at a lower risk. So don't blame me for the generalisations here or anything like that. So it was just, again, to illustrate examples that we see. Martin, if you'd be good enough to turn the page. So what we've got here, remember again, this is the £1.8 million coming out of the business sale. All the taxes are paid and it simply drops in the bank account there as such. So we've got David and Emma. So in the lead up to their exit at age 60 there, we've got their main residence, and all we've tried to do here, we're not trying to factor in things like what's the inflation rate going to be in the future and that. We've just tried to keep things constant as such. So the great thing about the tools that we have at our disposal, we can model these situations using these assumptions, and I think it's really important to emphasise they are exactly that. Just because it says on this screen that this is what takes place, reality plays out very differently, of course, as such. But I think for a lot of people, particularly being a business owner, looking at your future, and to Martin's points there before, things like key performance indicators, trying to plan things out, this is a really powerful tool in which to do that. So as you can see, in the lead up to retirement there, we've got their respective personal pensions, we've got the main residence, and we've got the current account there as well. But then at 60, that income that they're deriving from the business stops. They've got that £1.8 million to live off for the rest of their days in conjunction with their existing personal pensions and their current account money. And also we've put the main residence in there. So the key takeaway here is we start at just over £1 million at 60. Quite an important point. Inheritance tax thresholds for this couple here could well be £1 million, depending on their family structure. So it's nice that that figure there is that. You know, I'd leave that thought with you as such, but it's a really important number to bear in mind. And then progressively over time, all they're simply doing is drawing down that cash in the bank effectively to fund that lifestyle, that £80,000 per annum that they need to live off. All they're doing is simply drawing that money down. So you'll see there on the graphical representation, when they get to their early to mid 90s, they're actually run out of money, and they're having to, at that point there, almost take bricks out of their main residence to fund it. Now, if we were doing this presentation 25 years ago, a lot of people would have said, what, 90, 95 years of age? Surely not, I'll be dead by then. The reality is longevity, life expectancy, you know, that heart attack that killed the first person doesn't kill the first person anymore. So it's making sure that you've got sustainable wealth to last you without. We haven't factored in anything here to do with care homes or anything of that nature. But again, these may be issues that are relevant to yourself or could be relevant to yourself. So a very, very generic example there. So as you can see, at 100 years of age, their net worth is just shy of £370,000. So effectively, they've lost a third of the value of the property, and they've got nothing left as such. For some, age at 100, very aspirational, may not happen, but it's important to emphasise the changing demographics in society. Martin, if you could go to the next slide, please. So in the second scenario here, we've got a salary of $12,570. For those eagle-eyed in the room, that's the personal allowance, of course. And then that extra income is topped up by way of dividends. Again, expenditure of £80,000. Everything else in here, in the next 2 or 3 points, have stayed the same. However, what they do from 55 to 60, they've got a really good business. They can put up to £60,000 per annum straight out of the limited company into their respective personal pensions, saves corporation tax, and also puts money into a tax-free vehicle whilst the funds are accumulating there. So they do that for those 5 years. Then what they also do is you're allowed to pay into a pension even after you retire up to your 75th birthday, and you can put $3,600 a year in. Doesn't cost you $3,600, $2,880. The government give you £720 in the form of basic rate relief on top of that. Next point, this is where we come into it. 3% return, all right, but if you consider inflation's been running at somewhere around that on average over the last 3 or 4 years, maybe is there any scope to tweak that as such? So, you know, for the purposes of the illustration, we've just upped that a little bit. Not unrealistic, 5%. We've got clients at the moment who have got pension arrangements sitting in cash, earning over 4% without even any investment risk whatsoever. So we think that 5% is a reasonable figure to use. Business sale net proceeds, 1.2 million in this example. They both get their full state pension. Really important to understand if you've got a full entitlement to the state pension. You need 35 years. The easiest way to do that is the Government Gateway have a state pension forecasting tool. If anyone needs any help or wants the link for that, let us know. We're also assuming not only do they put money in the pension, they put money in the ISA there. So the limit has been retained at £20,000 per annum. We're not here to discuss where the money's been invested, whether it's in Nvidia shares or Apple shares or UK government bonds. We just want to illustrate the cash flow here. In this instance here, the pensions are used until such time as the current account is exhausted using tax-free cash initially. What do we mean by that is the first 25% of personal pension assets 25% of that is tax-free. A lot of rumour, a lot of speculation that Rachel Reeves was going to change that. There have been no changes in respect of tax-free cash entitlements as such. If we can have the next slide, please, Martin. Huge difference here. So at 100, remember before in the previous scenario, they were actually having to eat in, so to speak, into the value of their main residence. Here, no problems with the main residence. In actual fact, they've got almost effectively where they started from when they were at age 60 as such. So bear in mind, the business didn't generate as much of a sale. Why? Because they were using that business tax effectively to pay £60,000 a year into pensions between 55 and 60. So they gave themselves more time before they had to draw down that money in order to accumulate wealth in a tax efficient manner. Martin had a really good slide there before how the old entrepreneurs relief is going from 10 to 14% in April next year, and then it will jump up to 18% on the first £1 million in April 2026. Try and reduce the value of your business by looking at mechanisms, in this case pension contributions, to extract wealth to save yourself corporation tax in the lead up period there as such. When we have people come to us at the point of business sale, unfortunately, we haven't had that opportunity to look at what the planning opportunities might be prior to the transaction actually happening. Some good planning here brings us to this scenario. Martin, if you'd be good enough to turn over to the next slide. So in this case, remember, we were drawing money out of the pensions. So all we've got here is that they're using their tax-free cash in those initial years so they don't actually pay any tax during that period of time. You know, a decade ago, the then government changed the rules about pension access in terms of flexibility. So the great thing now is if you've got a pension arrangement that can accommodate this, you are free to choose whether you take money out of the 25% tax-free or you might use the bit that's taxable. So between 60 and 67 for David and Emma in this example here, they're actually using taxable income up to their personal allowances of £12,570, pay no tax. Thereafter, state pension kicks in, it's using up that personal allowance, we start to draw down on the tax-free cash. But all we're doing here, and the expression I use, is we're kicking that tax can down the road until such time as they will need to start paying tax again as such. It's really important to emphasise this. Pensions aren't taxed, they are taxable. Big difference. Martin, next slide, please. Scenario 3, we're just turning it on its head. If we were doing this presentation before the autumn statement there, we would have said this is the best scenario to use. You know, draw down the ISAs first, put the pensions back as far as possible. The quirks of Rachel Reeves saying that from April 2027, personal pensions will fall into the calculation to value someone's estate for inheritance tax purposes. That's changed the approach that we may adopt for some client scenarios. Before that, this is exactly what we would have done. We would have taken the ISAs out first, and again, kicking that tax can down the road for as long as possible. The numbers speak for themselves here. Very, very conservative, no pun intended, assumptions used in these projections here as such. We've deliberately tried to present it that way so as not to exaggerate people's expectations as such. So as you can see, at age 100, £2.5 million, a really, really nice problem to have. But again, care homes, that's a conversation we often have with people, intergenerational passing down of wealth and things like that. These issues become relevant because of the fact that in this scenario, the clients are in such a strong position, there needs to be a conversation about that transition of wealth there as such. Martin, if you'd be good enough to turn to the next slide. So what we've got here, that tax situation has been pushed even further out during that period of time there because the ISAs, of course, when they draw them out, they're 100% tax-free for both income and capital gains tax purposes as such. So all we're using is tax wrappers to generate future income. Again, there's no conversation around if it's Nvidia shares or Apple shares or Tesla shares. All it is about using tax wrappers to generate wealth in the future in a tax efficient manner. Martin, if you'd be good enough to do the next slide. So, you know, I won't go into the specifics here as such, but what we've just tried to illustrate is the inheritance tax outcomes. It's really important to emphasise that inheritance tax for either a married or a couple in a civil partnership doesn't become an issue until the death of the second party here as such. So when one person passes away, what's known as nil rate band passes to the next person, then it doesn't become an issue. I often make a joke with people that they just have to fly on separate private jets. But in all seriousness, I think it's really important to emphasise that inheritance tax, it's one of these things that's out there in society that people loathe, but you have to actually look at the statistics. Only a really small number of estates end up paying any inheritance tax there as such. So I'd imagine that we can get a copy of the slides to people that want them, so they can look through those figures to understand the things around nil rate bands. Martin, if you could turn the next slide, please. So in terms of inheritance tax, what I touched on there before, nil rate band, each of us, £325,000, talking about the transference between spouses. If you've got any children, stepchildren, adopted children, and you earmark your main residence to go to them upon the second death, each of us gets £175,000 extra. It's called the resident nil rate band. So this was introduced a decade ago. So if you do the numbers, that's where that £1 million come from for a married or a civil partnership couple, £325,000 each, plus the £175,000 times by 2. Anything over that allowance, chargeable to inheritance tax at 40%. If your estate, so that last example, you know, £2.5 million. So if you're over £2 million, the resident nil rate band is reduced by £1 for every £2 over this level. So you could end up back at the £650,000 level there as such. As it says at the bottom there, parent pensions have historically been exempt from inheritance tax, but this changes, and it's important to emphasise this. It hasn't come in yet. The government's going through a consultation, but in two and a quarter years' time, if what happens as has been flagged at the budget most recently there, pensions will come into that calculation. So it's thinking about, what do I need to do with pension assets in this tax year and the 2 subsequent tax years in the lead up to that there as such. You know, is incurring basic rate tax to extract money out of my pensions a good thing to save 40% tax in the future? Just an idea. Had a client situation last week, exactly that. Martin, if we can go to the next slide, please. So, as I say, pensions were outside of the estate for inheritance tax purposes. That's changed. So we need to think about, within our family group, within our wider network, what would we want to have happen in the future with our wealth? So thinking about gifting. Chances are there's people out there who are looking to give monies to next generations anyway, whether it's to be get on housing ladders and things like that. So each of us can gift up to £3,000 a year. If you didn't do that gifting in the previous tax year, you can do £6,000 in one go there. Anything over and above that, there's this 7-year clock. A lot of people talk to me about, well, Matthew, I gave someone £100 and that 7 years, isn't it, until outside of the estate? No, it's all a case of understanding what the various allowances and limits are. The second one here, I think, is going to be really important over the next few years about giving money out of regular income. So if an individual's in receipt of state pension and whatever else they're in receipt of in retirement, if they're not spending that money and they were wanting to pass that money on to other family members down the line, they can look to do that in regular amounts, as long as it's well documented and that money isn't subject to the 7-year rule. It can fall out of the estate immediately. Without going into great detail about myself, I'm in this situation. I've got people above me, myself, next generation, thinking about passing assets on that were going to be passed on anyway, but doing it in a tax efficient manner. Easiest way to sort out a lot of these issues is life insurance. May not be an option for some people. They may be in poor health. The cost of premiums could be prohibitive as such, as it refers to there. Martin, next slide, please. Business relief. There are products out there in the marketplace as such where you can pass money on. Some of those, I've just come from a presentation this morning with someone. There's a thing called the alternative investment market, or the AIM market. Some of the attractions of that have been diminished as a result of the autumn budget there as such. So again, very important to understand your specific circumstances and when these changes come in there, as the second bullet point talks about. So we've got until April 2026. When people hear the word AIM market, they think of high risk, great chance of losing money completely. Example I always give, there's a company called the Dart Group. The Dart Group own Jet2. They're listed on the AIM market as such. So those type of assets have been attractive, maybe not so much now. There'll be people out there perhaps who have got AIM investments in ISAs, always thought they'd be outside of their estate, maybe not so in the future as such. Then there's trusts, a completely different area, much more complex as such, but again, something that should be part of what we call a holistic financial planning exercise is considering trust arrangements there as well. Next slide, please, Martin. So, the conclusion, hopefully both Martin and my presentation here today, selling your business, you've worked hard, thinking about how you most appropriately go about it. There's monetary considerations, as we've obviously touched on, but there's also non-financial factors to bear in mind here as such, ensuring that assets go to the right people at the right time. But in the lead up to that sale, having that conversation with your accountant, your financial advisor, whomever it might be, about those things. Where our business works really well is we work in conjunction with one another. Martin sits literally 15 metres away from where I sit, and we can have that joined up thinking there as such. Budget changes, got to think about how does that affect maybe the plans you had in place. Thinking about how you're taking your income. And as with all of these things, review. What is true today may not necessarily be true in the near future as such. The key thing out of this budget most recently, a lot of the changes that are going to come about are happening at different times. Capital gains tax happen instantly. Inheritance tax with pensions, we've still got a 2.25 years up our sleeve. I think that's the last slide, Martin, if I'm not mistaken. But look, thanks very much for your time. It's an interesting world out there at the moment, but it's important to, hopefully take away from today some aspects that might apply to your specific circumstances, and getting the opportunity to talk to what your personal scenario is to ensure you are making the right steps. So thanks very much.
Okay, so thank you very much to our speakers. We've got no questions, and so that wraps up our webinar for today. You'll be receiving in about 1 minute's time.
Can I ask a question, David, if that's okay?
Okay.
So it was just probably one wee thing regarding the kind of ISA stuff. So I take it if you're putting into the ISA, you need to take that out as drawings personally, and you can't do that from the business. And do you think that's better tax efficient to take that out, even if you're a higher tax rate payer, and put that in? What's your thoughts on that, Matthew?
It's a really good question, Ryan, because to get that £20,000 in, if you are that higher rate taxpayer, obviously you've got to factor in that example there, 42% tax there as such. So if you were a pay-as-you-earn salary and wages person as such, the ISA, to go and get 5%, but to pay 42% in Scotland to get your 5% seems like a bit of a misnomer as such. However, taking money out of the business, dividend taxation at the basic rate, 8.75%, to get money into the ISA there, is a little bit more, feasible from the economics of it as such. As I was saying in the presentation, 3-4 weeks ago, I can't think of the last time I did a lot of ISA work for people as such because of that prohibitive nature of the tax. But I think it's key to emphasise that if you put £20,000 into an ISA, and if you went out and bought some Tesla shares, 2-3 weeks ago as such, you're already sitting at £25,000, no capital gains and no income tax. So I guess the approach we often use with clients is, particularly when it comes to the risk that they're taking with their money as such, they may look to maybe take a different view with risk on the ISA money to perhaps offset that income tax problem that people might have to get the money in there in the first place as such. I think ISAs have become a lot more attractive as a result of the budget as such, and the good thing is the government haven't reduced the amount you can put in there as well. I didn't touch on it, but very, very quickly, any people who've got children out there and they're at or approaching 18 years of age, there's a thing called a lifetime ISA, and that's where you can put up to £4,000 a year in for someone who's 18 years or older, and the government gives them 25% extra per year. So it's not just about, do I put money into an ISA? It's about what ISAs are most appropriate as such. I've got 2 children. I'm accumulating money at the moment through the junior ISA structure. You can put up to £9,000 a year. And then at 18, we'll turn that into lifetime ISA money there as such. What's my problem? To get that money in the first place, I've got to pay that income tax first of all. So it's a really good point. Just comes back to your personal circumstances.
That you answered your question, Ryan? Great. Okay. So as I say, you'll find there's an email winging its way to you in about 1 minute's time. You can provide feedback and you can ask for additional information in respect of this presentation. So everyone, thank you very much for joining us, and hopefully we'll be repeating this with more tax advice very soon. Thank you very much indeed.